Look, there is a lot of complexity around because of the ability of the market to digest the amount of issuance that needs to happen. And the more rates go up, the more issuance has to happen. And that cycle is not a good cycle. My personal opinion of this is the Fed are very aware of it. It's why they've been funding at the shorter end of the market and in the reverse repo take the strain. You've seen the Fed net liquidity has actually not gone anywhere, which is quite interesting considering. So the Fed are issuing at 3 months. Why are they doing that mainly? And from what I can tell is if they're issuing at 3 months, they know that they have to bring down the long end so they can issue further out the curve so that their normal funding cycle is 3 to 5 years. So to do that, I think they want to undershoot on inflation. So I think their aim is to undershoot on inflation and overshoot on unemployment. So you see both those dials moving, and that gives them the cover that they need to get rates lower, to ease the amount of issuance that needs to take place and potentially monetize it, considering the next year is obviously an election year as well. So I don't think things have changed. I think we are later in the cycle because the inflation pulse from post-pandemic was so big that they have to kind of let that play through, and I think it will play through. So my idea is that this doesn't change. It actually, I'm with Rosenberg's camp that there is a recession out there, and it's probably Q4, Q1. But my view has been that it's been priced in. So I'm very much and have been it's a boom camp. And don't forget, we've had rates this high, and the Nasdaq's up 42% this year. That tells you something. There's some informational value there. Much like there's informational value in the bond market, bond yields at this point, so late in the cycle, being so high. Okay, there's informational value there too, and I don't think it's driven necessarily by inflation, but much more around these supply issues. But that somehow has to resolve itself. I'm not sure how it resolves itself. Now, is there a possibility of yield curve control? And they step in kind of like the UK and said, well, the market's not pricing this correctly any longer. Don't know. But really, we have to get to the Fed pivot, or at least the Fed on hold, ECB on hold, before we can get there.
When could Bitcoin rise locally? Bitcoin BTC shows a minor 0.14% increase in the last 24 hours. On the hourly chart, BTC has formed support at $26,846. If the daily closing reaches $26,900 or higher, a resistance test could happen soon. However, the daily chart paints a less optimistic picture. Bitcoin remains close to the $26,533 support level, indicating sellers still hold the upper hand. Bulls need to push the price to $27,400 to gain momentum. On the weekly time frame, Bitcoin might close below the prior weekly low, a bearish signal that could lead to a drop towards $26,000. SEC drops appeal against Grayscale's Bitcoin ETF. The Securities and Exchange Commission, SEC, won't contest a court ruling favoring Grayscale's proposed spot Bitcoin ETF. This SEC's surprising decision opens the door for a comprehensive review of Grayscale's proposal. Grayscale's ETF aims to expose clients to Bitcoin without direct ownership. The SEC previously rejected all spot Bitcoin ETF applications. Grayscale challenged this decision in court and won. The ruling might influence other financial giants like BlackRock and Fidelity with similar Bitcoin ETF applications. Reasons to be bullish on Bitcoin. Crypto YouTuber shares 6 reasons for his bullish stance on Bitcoin. These include Bitcoin's decentralization, limited supply, secure and transparent transactions, wide adoption, its role as a hedge against traditional markets, and ongoing technological advancements. Ferrari accepts cryptocurrency for luxury cars. Luxury automaker Ferrari is now accepting cryptocurrency as payment for its cars in the United States. The company plans to extend this option to European buyers. They are using BitPay for crypto transactions without additional fees for customers paying with digital currency. This move comes as Ferrari aims for carbon neutrality despite environmental concerns related to cryptocurrency mining. Let's continue our discussion with Raoul.
We always talk about narratives, and what's fascinating right now is that there are multiple narratives. If you've been watching the most recent series of Crash and Boom, you've seen these narratives which are so incredibly different from incredibly credible individuals. You sort of think, well, how can that be? How can it be so different? You've had Raoul saying, recession's behind us, and off we go. You've had David Rosenberg saying, it's still down there and it's going to be terrible. And we had Juliet de Klerk saying, reflation's here, we're going to get reflation. And all these are plausible, and I listen and read everything that these people say. So what I'm going to do is go through some of these narratives and try and break them down. There's no right or wrong, because framework is the most important thing. And we've always said this at Real Vision, which is, some people want that trade idea. They want a one trade idea and run with it and make money. If I gave a trade idea out to a client, it would be hitting maybe 1 in 10 if I was lucky. But a framework is valid for everyone, whether you're a day trader or a long-term investor. So I'm going to try and break down those narratives and sort of look at what those different ideas are and basically go from there. So please do stop me at any point if there's anything you want to ask about, because there is no right or wrong. And I don't actually have an idea. At the beginning of this year, I said, this is going to be a really, really difficult year to predict. I held my hand up because I had no idea, and I still don't, which is why I'm using everybody else's ideas to illustrate that very fact. So, Vision Creative Labs, that's us doing stuff for other people, but more importantly, why the divergent narrative? So, what we're going to kick off with is normality. And what would be my normality is, what is a normal recession? Because we're all talking about recession. What is it that we should expect? And there are 1 or 2 features that have existed in every single US recession without fail. And some of the narratives we're going to hear are saying that this is not going to happen this time, which could be valid. The first one is unemployment and recessions. Unemployment is the most important element of every single US recession since the war, and probably before. And you can see here on this one, every single one of these recessions in grey, you have this massive acceleration in the unemployment rate without fail. So that's the one of those factors that you need to have if you're going to have a recession. So far, we're starting to turn, but it's a minor turn. And if you look here, nearly all those turns happen well in advance of a recession. So if we've only just turned, that would suggest that if there is a recession, it's still quite a way off. But the important thing here is unemployment. Now, revisions could come in and we could find out that actually unemployment was 5% today with revisions, but we'll only find out in 18 months' time. But right now, that's something we've got to be looking for. And the second thing people talk about is things like ISM. They go, ISM's in contraction territory. This is the manufacturing below 50. That's a recession. Well, yes and no. You can see here that often you get the ISM manufacturing deep into negative territory, so below 50, so deep into negative territory. But there have been many, many occasions when ISM goes negative or goes sub 50, and we don't get a recession. We've only had a recession when we've had ISM below 50 and unemployment screaming higher. In fact, there's only one occasion really where we've had ISM below 50 and unemployment high without a recession. That was this one here, which was post the dot-com crash. And that was because we were after it and was rolling back over on unemployment. So ISM is relevant, but it's nearly always coincident. But you need that unemployment. And then the third thing, which has been a factor of every single US recession, is that you get a tradable low on the equity market in and around every recession, because some people are saying it's behind us. Now, I'll give the caveats first, which is in the 1980s, you had little mini pullbacks in the market here. And in 1991, a little mini pullback. This is a log scale. But generally, you get big, big moves through, and you get a tradable low which is maybe not generational, but something pretty impressive. So if we're saying that we've seen the low, then we're saying again that this is very, very different. But that's normality. That's what we would normally look for, and I've been looking for. And I'm worrying that maybe my old framework is coming under pressure and might be wrong.
Cycles, and the markets are moving to this period where they will become increasingly unstable. So I'm definitively in that camp. That definitionally pushes you towards more active management. It ain't easy though, right? If you think you're going to catch every single one right, you're wrong, because you will not, because something will catch you out in this. This is a very dangerous period, we think, we're entering.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.